Assalamualaikum and good morning everyone. Let's begin with an overview of Islamic finance. Islamic finance is a system that operates under the principle of Sharia or Islamic law. It is fundamentally different from conventional finance in that it prohibits interest, also known as riba, and instead promotes risk sharing between parties. Historically, Islamic finance has deep root going back to the medieval era when it helped foster trade across regions like in the Middle East, North Africa, and Asia. Interestingly, many of the ethical and trade-based concepts moving into the post-1960 period later influenced the revival of Islamic finance, especially in post-colonial Muslim countries. This revival was not only financial but also cultural and religious, as nations sought to re-establish the Islamic identity after colonial rule. Egypt and Malaysia were among the pioneers in the space. In the early 90s, they established interest-free banking system, marking a significant turning point. A key example from this period is the Mikha Bank in Egypt, which operated on profit-sharing principle. Now let's look at Malaysia Premier Fund, which helped Muslims save and invest in preparation for the Hajj, largely driven by the oil boom, which increased wealth in many Muslim-majority countries and fueled demand for Sharia-compliant banking services. In 1974, the Dubai Islamic Bank was established, becoming the first Islamic commercial bank. A year later, the Islamic Development Bank was founded in 1975, aiming to support economic development in line with Islamic principle. Countries like Iran, Pakistan, and Sudan were
In the 1980s, Islamic financial faced skepticism, especially from the Western economies. Many believed that without interest, people would save, investment would dry up, and monetary policy would be ineffective. However, scholars respond with a clear counter-argument. Islamic financial is not return-free. It simply replaces interest with the profit-sharing mechanism. In Mudarabah, for instance, profits are shared according to a pre-agreed ratio, and losses are borne by the provider of the capital, unless there is the negligence. Economists like Lawyer Mazer and Mohsin Khan draw the modeling that Islamic banking could actually be more stable. Islamic financial especially in avoiding the debt-based beliefs of the conventional system. This moral and legal framework drives practice that prioritize justice, risk-sharing, and ethical investment. Rather than rely on debt and guaranteed return, Islamic financial use asset-backed contract and equity-based structure like Mudarabah and Musyarakah. Misled economic model show that such a structure could stabilize market by minimizing leverage and aligning financial activity with real economic growth. This system also forbids riba interest, gara, uncertainty, commercial gambling, which are seen as a source of financial instability. It was implemented on a national scale. Countries like Iran, Sudan, Pakistan fully transitioned their banking system to Islamic principle. Others, including Malaysia, Bahrain, and the UAE, adopted dual system where Islamic and conventional bank coexisted. During this era, we also saw the growth of Islamic equity funds offering ethical investment option, the rest of takaful or Islamic insurance, and the insurance of the sukuk, Sharia complement bonds. In 1999, Dow Jones Islamic Market Index was launched, enabling global investors to track Sharia complement companies. Institutions like IMF, IFSB, and AAOIFI also began to acknowledge and study Islamic financial as legitimate, stable, and inclusive alternative.
Offer Sharia-compliant financial services. This window operates independently from the bank interest-based activities, adhering strictly to Islamic finance principles such as no interest, profit and loss sharing, ethical investment. So why did Western bank create Islamic window? First, rising demand for Sharia-compliant products. Second, tapping into a lucrative market. And lastly, enhancing brand reputation. So example of Islamic windows in Western banks are HSBC Amna, Citibank Islamic, and PNB Paribas National. Consistency across countries. Islamic finance operates globally from Malaysia and Saudi Arabia to the UK and South Africa. These standards help harmonize practices across jurisdictions, boost investor confidence. Global investors and institutions are more comfortable investing in Islamic finance when clear, transparent, and consistent regulations are in place. Supports risk management. Helps Islamic financial institutions manage risk like Sharia non-compliance, operational inefficiency, or financial instability. And last, prevents misuse of Islamic labels. Regulatory bodies ensure that only truly modern Sharia-compliant products are marketed as Islamic, avoiding Sharia-compliant alternatives to conventional bonds. Instead of earning interest, investors earn returns from profits generated by underlying assets or projects. Sukuk allow governments and companies to raise capital without violating Islamic principle. Sovereign sukuk issued by governments to fund national projects such as roads, hospital, and school. Corporate sukuk issued by private companies for business expansion or large-scale investments such as Emirates Airlines. And finally, new institutions supporting Islamic finance. Islamic International Rating Agency provides Sharia-compliant credit ratings for Islamic finance
around the world. It its key strength lies in offering ethical, stable, and interest-free financial alternative which appeal to those seeking fairness, transparency, and social responsibility in finance. Looking ahead, the future of Islamic finance is very promising, not just because of oil wealth in Muslim-majority countries, but also due to the rising global interest in ethical and sustainable finance. As the world continues to evolve, Islamic finance is well positioned to play a significant role in shaping a more inclusive and just financial system. I think that's all from us. Thank you so much.